Hi guys, how are you? Welcome back to Real Macroeconomics and Investing. Patreon.com/realmacro. Come down, like, follow, subscribe, and we're talking about the monetary system, macroeconomics. We're talking about trading, investing, charting, technical analysis, live trades, live portfolios. You name it, we do it. All right. So come down, me. There's no we. Well, my subscribers help. All right. So let's get started. In this video, we're going to talk about why interest rates work in certain economies and other economies they don't work. Okay, so we got a lot to debunk, so let's get started. All right, before we start, I'm going to kind of review really quickly how bonds work. A lot of people have difficulties with this. So remember, when bond prices fall, interest rates rise and vice versa. Okay, very important to understand. Now, there's a lot of people that argue that higher interest rates cause inflation. That's not true. Okay, there's people that argue that it is the Fed that sets rates. The Fed sets short-term rates, not long-term rates. Long-term rates are set by the market. Okay, so I'm going to prove that to you right now, and I'm going to show you what happened recently. 1 second. All right, here we are. So what happened recently when we started to get inflation? All right. In 2020, end of 2021, I'm sorry, 2021, what happened is the free market, this is the 10-year bond right here, 10-year rate, the 10-year rate started to rise way before the Fed started to raise rates. Okay? This is proof that the free market started to sense there was going to be inflation, and they started to take reactive measures. Okay, they started to raise interest rates to cool off the economy by making borrowing more expensive. Now, to do that, they had to sell off the bonds. Okay, so they started selling off bonds, making it cheaper and cheaper, but nobody wanted them because they wanted to raise interest rates. Well, why did they do that? Because they're greedy. Okay. The bond market wants a real return on that interest. Okay, what is a real return? Again, if inflation is 5%, they want to get at least 5% return on their money, so they don't lose purchasing power. Anything above that is return on investment. Okay, so if it goes to 10% and you have inflation of 5%, you're making 5% real rate, right? We'll talk maybe a little bit more about that later. Okay, so it took about a year before the Fed realized that we do have an inflation problem. When the 10-year bond was screaming, hey, we got inflation, and the Fed was saying, no, it's transitory. Okay, so finally, after about a year, or almost a year, the Fed started to raise rate, and it was behind the curve. It was chasing the market higher. It wasn't until the end of, or mid to end of 2022 when the Fed raised rates above what the 10-year did. Okay? It was playing catch up, and then they raised them enough where they started to see inflation start to cool off. Okay? So this is what I mean that, greed helps fix the economy, because money started to sell bonds to raise interest rates, to make borrowing more expensive, to cool off the economy, and that's what happened. Okay, so it worked here. In this case, it worked. Now, okay, so let's take a look at this example here, which is Turkey. All right, so Turkey tried a couple of things. Interesting. They thought that interest rates were causing inflation. So, so did other people. So they started to lower interest rates, and what ended up happening in an inflationary environment, and what happened was inflation was at 20%, and when they started to lower rates, inflation went up to 86%. Then they started raising rates, but it was too late. Why? Because everybody lost faith in the currency. Nobody was buying big ticket items with Turkish lira. And the reason they weren't using the Turkish lira was because they couldn't trust what the value was going to be tomorrow. So would you want to sell a home for, X amount in the Turkish lira, and then by the time, you sign all the paperwork, everything goes through and whatever, you're going to get half in value in that currency. You're not going to do it. So what are you going to do? You're going to use the euro, you're going to use the pound, you're going to use the dollar, right? So you cannot control interest rates when no one is using your currency. When people lose faith in the currency, they'll use it on the everyday, buying food or whatever, anything that's going to be quick, right? Because as soon as you get the money, you want to go out and buy groceries because it's going to be devalued the day after. So in that case, yeah, you will use the local currency. However, if you want to sell a home, you want to buy a car, you want to take a loan, you want to do a business loan, whatever, you're not going to do it in Turkish lira. You're just not going to do it. Okay. So that's why no matter where you raise interest rates, it's not going to work. It's too late. You're not going to start to reduce the amount of borrowing that's going on in the economy because no one is borrowing in that currency. So no matter where you put interest rates, it's not going to work. Okay. So let me give you an example of this. First of all, this purple line here, this is the money supply. This is M1, okay, the most liquid form. So the money supply kept rising and the currency value kept collapsing, right? Now, let's kind of slice this up just a little bit. You're going to see here they started to raise interest rates right in here. And what happened is the currency started to stabilize. And then they started to lower interest rates here, and the currency started to devalue again. They started to fall apart. Then they raised interest rates again, and then the currency started to stabilize again. And then they started to lower rates, thinking that that's what's causing inflation, and everything just collapsed from there on. The Turkish lira, when they first started to lower rates as inflation was rising, was 8-1. 8 Turkish lira for $1. Today, it's somewhere like 34.5 Turkish lira for $1. So you can see the massive devaluation that went on. And again, inflation went from 20% to 86%, and the Turkish lira to the dollar went from 8 to 34.5, maybe. So in that case, no matter where you put interest rate, it's too late. You're done. It's not going to work. Now, what happens is some of these so-called economists, they start talking nonsense, and they start saying, no, it's because they're raising interest rates. That's why there's more and more inflation. No. You see, they put the cart ahead of the horse. They're saying that the cart is pulling the horse. In this case, no matter where you put interest rates, it's not going to work because nobody's using that currency beyond the everyday necessities. Okay? So someone who doesn't understand economics and doesn't understand what I am telling you today is going to conclude that yes, every time they raise interest rates, the currency keeps devaluing. Yes, because no one is using that currency. So wherever you set interest rates, nobody cares. In the U.S. case, it does work because everybody's still using the currency. We're not in dire situation. We're not lowering interest rates when we have inflation, right? We're not doing stupid things. So it's working. Okay, it's working and it works great. I will give you one more example. This is the Argentinian currency. Second. So here is the Argentinian interest rates. They went as high as 125%, and it, of course, did absolutely nothing to help fix the inflation problem that they were facing. I believe inflation hit like 350%. I'm not going to pull it up now. You can look it up yourself. But yeah, at that point, when no one is really using the pesos, nobody's going to really care where you set interest rates. Okay, remember, interest rates are good to buy you some time so you can fix, get your house in order, um, set up a nice, austerity measures, and start to fix the economy slowly by not, adding more slices to a pizza pie, right? More cuts in a pizza pie is not going to make the pizza pie bigger, and that's what basically inflation is. Raising interest rates is not going to, fix the if you just keep pumping in more and more and more and more money into the economy, right? So it's not going to do anything, especially when no one is using it. So that's it. That's why interest rates work sometimes and other times it doesn't. It really has to do with how bad they have destroyed the local currency. Um, Monetary becomes useless at that point. Right? If you still have a functional currency and you're getting inflation spikes and you're raising interest rates, you're doing what you're supposed to do, then it's a warning shot, right? Inflation is always a warning shot that hey, maybe you got to start being really cautious. The way you're printing money, the way you're borrowing money and pumping it in. So you should pay attention to it because you just never know when things are going to really start to blow up. And once they start to blow up, it's too late. And you can really see that in this chart, right? Everything's kind of nice and stable, and then everything just starts to get out of control. Interest rates went as high as 75% the first time, the second time went as high as 120, whatever it is. Right? Inflation was just rampant and just a disaster. It's too late then. Interest rates are not going to help you. Okay. So that's it for this video. In the next video, I'm going to pick another topic. So make sure you follow, like, subscribe, and I'll talk to you guys soon. Thank you very much. Take care.